Wrap the month for the month of August. It was a tough month, second worst month of the year. The other worst month was in February, where you had the S&P down almost 2.6%. This month, the S&P was down 1.6%. We're going to jump into what that means, all the different indices that we track, and we're going to do it in 11 charts. All right, chart 101 of 11 charts to show you how we did in the month of August. S&P 500 was off 1.63%. NASDAQ Composite was off 2.18%. Small caps, which will be a recurring theme in this, off over 4%. And the total bond market was down 0.65%. So like we said in the opening, not a very good month for the month of August. Not at all surprising. A lot of times, the late summer months, you have a lot of people traveling, a lot of people away on vacations, getting ready for back to school, getting ready for, colleges. The month of August typically and the beginning of September typically are not great months because people just have so many other things going on. It's hard to focus on the markets per se. That doesn't always, mean that that's true, but more often than not, towards the end of the summer, you get more low trading volume, which can lead to bigger price movement swings. So as we look at our funds that we have in our portfolios, we have SPY, which is the cap weight S&P 500, which was off 1.63%, which is still greatly outperforming our equal weight RSP for the year. And we'll see that in a second, but for the month off 3.19%. So 3.19% to 1.63%. The mega caps are still outperforming the overall market. Vanguard dividend appreciation down 1.91%. Small caps off 4.1%. International was not really giving us much diversification or much cover here, off 4.39%. International small cap 3.93%. Our short-term Vanguard bond fund was up 0.23%. Our one loan kind of winning fund with the international bond was 0.22%, but the intermediate bond, the Vanguard total bond market, down 0.65%. That's how we did for the month of August. Now to chart 102, how we are doing the past 12 months. The past 12 months, S&P 500 is up 11%. NASDAQ is up 13%. Small caps are up 4%, and the total bond market is down 3.8%. Interest rates are still kind of driving that on the bond side. We'll get into that later. Again, we've got the same issue here for the past 12 months. The cap weight S&P 500 is up 11%, while the S&P 500 equal weight is only up 4.6%. We have not seen this much of a divergence between these two in quite some time. And as a matter of fact, some people are saying, well, why are we still in equal weight? Well, equal weight has proven to perform well and outperform. In fact, last year, equal weight outperformed S&P pretty handedly. So that's why we kind of stick with it. But we are tracking it to kind of see what's going on there, because if this continues, we may look to switch and go to the cap weight for the time being. Vanguard dividend appreciation last 12 months, 8.66%. Schwab US small cap, 4.24%. International 7.4%, international small cap 3.9%. Short-term bonds down 0.21 with the Vanguard short-term. Vanguard total bond market off 3.8%, and our international bond 2.63%. As we get to year-to-date, how we're doing year-to-date, the NASDAQ Composite is flying up 35% with a lot of those big tech and AI kind of leading all the rage. S&P 500, good year still. With all the noise and nonsense going on, the S&P 500 is still up as of the end of August, 18.65%. Small caps up 9.9%, and the Vanguard total bond market for year to date, we'll take it comparatively to how it was in 2022, up 1.62%. But again, you see the huge discrepancy of the S&P 500 cap weight versus the equal weight, 18.65 versus 7.13. For year 2023 as of August 31st. Vanguard dividend appreciation up 8.48 year-to-date. Schwab US small caps up 9.9 year-to-date. International stocks up 9.1. Small cap international 8.63 with the Schwab. Vanguard short-term bond up 1.83. Vanguard intermediate bond up 1.62. And international bonds up 3.86. Okay, as we look at market breadth, the market breadth is slipping. We talked about the S&P 500 when we're looking at the 50 and 200-day moving average, which is the chart that we're seeing here, which basically since March has been a pretty positive uptrend. But you can see here in August, we kind of dipped below the 50-day moving average, which is a negative bearish indicator, but we kind of recovered a little bit towards the end of August. It's still an upward trend. Relative strength, RSI here, we're seeing it come down. At the beginning of August, we were up just about 70 or over 70. Now we're down to 57.19. So we're starting to see a little bit of a divergence. We're starting to see, which we've talked about before, the strength of the market isn't really all there, but we're starting to see it kind of, deteriorate. 44% of S&P 500 stocks are above the 50-day moving average. So again, we're not at 50%. The beginning of August, we were up over 80% of the S&P 500 over the 50-day moving average. 44% of 500 represents 224. S&P 500% over the 200-day moving average is a little bit better than the 50-day. We're at 57%, which is 285 stocks in total. So what this chart is telling us, as I scroll back up here to kind of just look at it from a macro level, is we're still in an upward positive bullish market trend, but by the skin of our teeth, as you can see here, we kind of broke down that 50-day from a shorter term. We're still very much above the 200-day, but starting to show some cracks, some signs of weakness. Let's look at the NASDAQ for, the market breadth here. Same exact story, same exact scenario. We're starting to see some weakness in here. The NASDAQ traded below its 50-day. It's back up at the end of August, but barely. Relative strength, 58.79. So we are coming down from where we were, again, at the beginning of August, end of July. The percentage of NASDAQ stocks above its 50-day moving average is only at 34%. That's a worry. This year has not been driven by many NASDAQ stocks, but you are seeing the few of them that are really making it fly, which is really AI in that kind of space. But again, from the beginning of August, we have dropped down dramatically. So 34% above its 50-day moving average, which represents 1,149 holdings. Above its 200-day moving average, not much better, 36.39%, which represents 1,210. But again, you're starting to see signs of weakness, cracks here, which would make sense when we, did not have a great month of August. So not really a huge surprise here. As we're looking at, again, we've discussed this before. We're looking at value versus growth. Value versus growth this month underperformed by 1.8%. Which means that growth outperformed value, which represents different trends in the marketplace. Growth stocks are more tech-oriented companies that aren't paying back to shareholders as much. They're not issuing many dividends. And when you have value companies, it's kind of the exact opposite. They're more of your blue chip, maybe companies that are deemed to be cheap in the marketplace that are on sale and a good buy and are also paying more dividends on the growth side. But these represents different trends in the marketplace. Something that we like to pay attention to. And for the month of August, growth outperformed value pretty handily. Consumer discretion versus consumer staples. Discretionary are things that we don't need in the marketplace. Staples are things that we do need. They tend to follow patterns that if staples are outperforming discretionary, that tends to be a more bearish indicator. And if discretionary is outperforming staples, tends to be a more bullish indicator. For the month of August, outperform staples. So by a tune of 2.346%. When you break down each of the funds, though it outperformed by 2.346% discretionary over staples, they both had a bad month. So for discretionary, the month of August was down 1.75, while staples were off 3.95%. Jumping into consumer sentiment. No surprise when you have a bad month, probably consumer sentiment is down. So consumer sentiment dropped from our July reading of 71.6 down to 69.5. Jumping to interest rates. Same story here as we've had for, past 12 months or so. We have an inverted yield curve, which means, again, the 10-year treasury is yielding less than the 2-year treasury by about 0.71%. So the 2-year treasury is paying you 0.71% interest more than the 10-year treasury. And here's another way to look at it. So the 10-year Treasury is yielding 4.27%, where the 2-year Treasury is yielding 4.98%. Again, red line, which represents 2-year, when it's higher than the green line, you are going to see an inverted yield curve, like we've seen basically since about halfway through 2022. So a little bit over a year now. As you would see this, where we wouldn't have an inverted yield curve if in this chart the green line was outperforming the red line. And it's more dramatic on a short-term basis. A 3-month Treasury is yielding 5.56% compared to a 10-year of 4.27. So again, we have an inverted yield curve. Not much here is changing. All right, well, that's a wrap on August Wrap the Month. Hope you found it helpful. Any questions, drop them in the comments below. Shoot me a text, email, phone call. But until next month, have a great rest of your day. See ya.